The Chinese are living longer, but the country is also seeing a declining birth rate. Less young people will be supporting an ever-swelling graying population. Now that's put the sustainability of pensions and how people can maintain a quality life in their later stages of life front and center of China's national policy. Like nations with advanced pension markets, China has a three-pillar pension system, but with each pillar at a different stage of development. So the first pillar consists of the public pension funded by the government. The second is employer and employee contribution pensions, and the third is personal pensions where individuals choose investment funds and investment managers to steer their retirement plans. There's no one-size-fits-all model for a nation's pension system. Different countries employ different mixtures of how much each pillar contributes to pension plans based on historical as well as national conditions. For example, with the mature capital market, the United States relies more on the second and third pillars, whereas Germany, the first in the world to introduce a social security system, relies more on the first pillar. In China, the first pillar, or government-funded pensions, dominates as of now, but policymakers have clearly indicated an emphasis on the urgency of developing commercial pensions, or the second and third pillars. Indeed, this is the global trend, as pension plans rely more on the capital markets, as governments face growing fiscal pressure with aging societies around the world. The third pillar of China's pension system, the individual pension scheme, is still in its infancy, so it's quite the blue ocean here in China. Now, this presents massive opportunities for fund managers, for banks and insurance companies, whether domestic or foreign. Now, according to the OECD, China's pension assets as a percentage of GDP stood at around 1.9% in 2019. That's compared with the OECD average of nearly 40%. There's a lot more room for China's pension market to grow in terms of pension product innovation, as well as in scope. Now, as a bit of a latecomer to developing its private pension market, it will also be interesting to see how the forces of Fintech will shape this market here in China. We know the Chinese are fast adopters of technology because, according to S&P, 38% of adult internet users are employing robo-advisors as of last year. Those who are not, 68% say they have some level of interest in using one in the future. Now, Fintech is already playing a big role in the affordability and accessibility of investing for China's retail investors, so it won't take a leap of imagination to see Fintech playing an even greater role in spurring faster financial innovation to develop China's private pension markets.